Hey everyone, welcome to Immortal Trade. I'm really excited to have you here. My goal on this channel is simple: to make tradings easier and clearer and more enjoyable for all of us. I'm not here to act like I know everything. I'm here to grow with you. We are building a community where we learn together, share real experiences, and level up our trading skills step by step. So, if you are into honest insights, practical strategies, and good energy, you're in a good right place. Let's start this journey and make smarter trades together. Hey everyone, hope you are doing great. In this video I want to walk you through some absolutely essential trading concepts. Stuff that can seriously change how you approach the markets. We are going to cover how to properly manage your capital, what real risk management actually looks like, how to calculate risk-to-reward ratios, and the importance of your win rate in long-term profitability. Now, maybe you are thinking I already know this, but trust me, most traders, even after months or years in the market, still skip the fundamentals. Or worse, they think they're applying them, but they are not. Whether you're a beginner or an experienced trader, the videos on this channel will help you get a strong start or become an even better trader. Let's get into it. Why is capital management so important? You might hit a few lucky trades, double your money once or twice. But if you don't control your risk, if you don't know how much to put into each trade, eventually the market will wipe you out. It's simple. No structure, no future. Let's say you've got $30,000. You go into a trade and lose 30%. Then another and another. Before you know it, half your account's gone. At that point, recovery becomes incredibly hard. But if you're only risking 1 to 2% per trade, you can survive multiple losses and still stay in the game. Here's a basic formula you should memorize. For example, if you have set aside $100,000 for trading and you risk just 2% per trade, that means you should never lose more than $2,000 on a single trade, no matter how short it feels. How much position size that translates to depends on your stop-loss stance. We will cover that too. When I say total capital, I mean the amount you have allocated for trading, not necessarily your entire net worth. You could have $300,000 overall, but only $20,000 in your exchange account. Still, if that full $300,000 is set aside for trading, then that's your true base capital. Now, the real questions are: how do you calculate position size based on your stop loss? How does your win rate combine with risk to reward to determine long-term profitability? And how do you build a plan that keeps emotions in check? Alright guys, let's talk about something super important. Daily risk percentage. Basically how how much of your capital you are willing to lose in a single day without mentally falling apart or ruining your strategy. If you don't create your own rules, the market definitely won't do it for you. Now, maybe you're thinking, I'm fine taking a 10% loss in a day. Cool. But let's do the math. If you lose 10% today and then again tomorrow and the next day, that's a 30% loss in 3 days. That's why 10% daily risk is just too much. What does that mean in practice? You can either take one big trade with 2% total risk, or split that across multiple smaller trades. Doesn't matter. The combined risk of all your trades in a day shouldn't exceed that limit. Later in this video, I'll explain how to set your risk per trade and how to split it properly across positions. But for now, just pick one fixed percentage. 2% is a solid start. And stick to it for a while. You can always adjust it later once you get more consistent. Now, let's move on to leverage. In the formula we use to calculate position size, almost every variable is under our control. And contrary to popular belief, leverage doesn't matter that much, except in two specific situations. Let me explain. Most people overthink leverage. They treat it like it's the most critical piece of the puzzle. But really, leverage only becomes important in two cases. One, when your stop loss is wide, say 3% or more. In that case, if you use insane leverage like 100 times, your position could get liquidated before your stop loss is even hit. So yeah, here leverage matters. You have to scale it back to avoid early liquidation. 2. When your stop loss is tiny, like 0.2%. Now, you might need to increase leverage just to reach your usual risk amount. If your stop loss range is too tight, and you want to risk $500 for example, low leverage might not give you the position size you needed. In that case, bumping up your leverage to 50 times or 100 times might actually make sense. So the point is, leverage only matters in those two specific cases. Other than that, just pick a number like 10 times, lock it in, and focus on the more important stuff like risk management and technicals. Back to the formula. Here's what you needed to calculate your position size. Total capital. You already know this. Risk percentage per trade. You define this based on your strategy. Stop loss distance. You get this from technical analysis depending on the structures of the chart. Position size. This is the only unknown variable. We will calculate it using the rest. Your stop loss level should be logical, not based on your emotion or guesswork. It should be a technical level. You're okay exiting the trade if that price hits it. Let's say you're trading with $10,000. Now, the biggest mistake would be throwing the entire $10,000 into a single position. What you should do instead is use only part of that, maybe around $200, based on your calculated risk. That's the whole point of risk management. You control how much you're exposing, not gamble everything at once. Now, let's get into something crucial: risk-to-reward ratios. Risk-to-reward on its own doesn't mean much, but when you combine it with your win rate, that's when get things interesting. Together, they determine whether your strategy is actually profitable or just draining your account. Let's play a thought game. Imagine I offer you a deal where you have a 99% chance of losing, but if you win, you make $10,000. Would you take it? Probably not. But what if I told you that that same 99% chance of losing could bring in $500,000 if it works? Now, it gets tempting, right? What's strange is in that real life, we make decisions based on this logic all the time. We wouldn't risk $500,000 just to make $50. But if the reward was 5 million, we'd consider it. Yes, in trading, most people do the exact opposite. Here's what I mean. You risk $1,000 on a trade, but once it hits $200 in profit, you instantly close it. Or even worse, sometimes you lock in $100 or $50 profit, while your stop loss is $1,000. Let's do the math. You win 10 trades at $100 profit each. That's $1,000 total. Then you lose one trade for $1,000. Boom! All that profit is gone. And this cycle keeps repeating. No wonder people say stop loss doesn't work. They win a few trades, hit one stop loss, and the entire account take a hit. Honestly, I don't blame them. If your system is built around poor risk to reward ratios, using a stop loss feels like punishment. But here's a better approach. Instead of trying to win small over and over, build a system where a couple of big wins make up for multiple small losses. That's how real consistency in trading is built. Now, if you're struggling to let your profits run, it's probably because of one or both of these reasons. 1. You're not managing risk properly. You're afraid of taking a loss because it's too big. 2. You are using risk management, but your position size is still too large for your comfort level. And that's not a bad thing. There is nothing wrong with having a lower risk tolerance. One trader might comfortably handle 3% risk, while another sticks to 1.5. That doesn't make one better than the other. It just means you need to know your limits and work within them. Here's the powerful part. There is a direct connection between your risk to reward ratios and your win rate, and we are going to explore that now. Let's say you've got a setup like this. Your entry is here. Your stop loss is $10 below, and your take profit is $30 above. That's a 1-to-3 risk to reward ratio, meaning you're risking $10 to potentially earn $30. Now, if you close your trade early, let's say at $10 profit, you're throwing your whole risk model off. Why? Because you're consistently locking in small gains while still taking full-size losses. That's how accounts slowly bleed out. The truth? Your brain hates losing. So it keeps saying this trade will come back when you're down. And when you're up, it panics and says, take the profit before it's gone. It kills long-term growth. But if you can zoom out and look at the big picture, You will realize that taking small planned losses and holding on to strong setup is the real game changer. If up until now you haven't been using risk management, that's okay, but from this point forward, it's non-negotiable. We talk about it. We talk about it at the beginning of the sessions. Time to take it seriously. Now, let's move on to the second key point. You're not managing risk properly. If this is still an issue, don't worry. I will cover it in details right after we finish with the risk reward section. Third, you're properly trading without a stop loss. Look, we have already discussed this multiple times and I won't talk about it anymore. Fourth, you're not even sure what you want from the market. That's a real problem. You can't just jump in and see what happens. This isn't about luck. You need a clear goal. You have to define what your daily target is and how do you plan to get there. The market won't always give you what you want, but when you are consistent and disciplined over time, you will get what's yours. Now, let's get into something extremely important. What's the minimum acceptable risk-reward ratios? In my opinion, it should be at least 1 to 2. Here's what that means. If you're risking $100 on a trade, your minimum profit target should be $200. Now, compare that to a 1-to-1 ratio. You risk $100 to make $100. To stay profitable at a 1-to-1 ratio, you need to win more than 50% of your trades. But with a 1-to-2 setup, you can still make money even if you win only 35 to 40% of the time. That's the power of asymmetric risk. So when you say I only take trades with a 1-to-2 risk reward, here's what that really means. If your stop loss is $50, your take profit must be at least $100. If the chart doesn't allow you that space based on your technicals, simply don't enter the trade. Your analysis should help you identify whether that minimum profit is realistic. Sometimes you might even have room to target 3 times or more. That's great when it happens. And now, the concept of win rate finally starts to make sense. If you consistently go for trade with a 1-to-2 risk reward ratio, you don't need to win half the times to be profitable. Even if you win 4 out of every 10 trades, you could still be in profit. Why? Because the wins are larger than the losses. Success in trading comes down to balancing your win rate and your risk reward. Once you understand that relationship, you already halfway there. Thanks for watching. I hope this video gave you some useful insights into the market. Don't forget to like, subscribe, and leave your thoughts in the comments. Until next time, stay sharp, stay focused. Goodbye.